Now, as far as safe haven assets go, what are assets that people should avoid? What is something that could potentially crash in the next 3 years? What should people avoid right now?
Again, be very careful of duration in the sovereign bond markets. I think the long end of everybody's yield curve is horribly mispriced. And the reason is for this, right? When you have a yield curve inversion, right, if that's the market saying in 2 years, so the 3-month is trading, Treasury is T-bill is trading at, say, a point, just to make the math easy, lower than the 2-year. And the reason for that is that the bond market, the bond traders are betting that the central bank is going to cut interest rates within 2 years or at that 2-year mark. And they're going to cut interest rates farther than in such a way that they'll make more money on the price rise in the bond itself than the interest rate, than the yield spread between the 3-month and the 2-year, right? That's why they do it. That's an anticipation of the market. And I think that that's perfectly reasonable analysis when you're talking about a core economy or core market, a first world market. The shocking thing that's coming over the course of the next 3 to 5 years is when the markets start trading what used to be first world markets as third world markets. So you don't apply that same logic to Vietnam that you do to the United States. When capital's fleeing Vietnam, the whole yield curve blows out and the central bank has to raise interest rates to protect capital flight. The whole yield curve blows out. Inversions don't matter at that point. The whole thing is just rising from 6% to 16% or whatever it is. We saw the other day with the Russians raising interest rates from 8.5% to 12% overnight in order to stop the run on the ruble, which I also believe was a run on the Chinese yuan for a variety of reasons. But we have to start thinking about certain geographical jurisdictions as if they're not first world markets. They're not developed markets, that they have fallen down the curve to frontier or to emerging or frontier markets. That's what we have to start thinking about. And I'm telling you right now that you should start thinking about Germany, France, the UK, Canada, and Australia as emerging markets, not as first world markets. If you do that and you start to see the world that way, you'll understand what's going to happen in the sovereign bond markets over the next 3 to 5 years. Hi, I'm Tom Luongo, and you're watching Think Smart Education.